London be the world's first to deliver on climate change commitments. The way the City of London measures success is constantly changing. A new generation of discerning customers has skyrocketed the importance of environmental, social, and corporate governance to company decision makers. The finance sector is increasingly being seen as the next frontier in climate action. As the city navigates the post-Brexit landscape and our pandemic recovery, it will also be tasked with redefining its role on the world stage. So how will the government's net zero commitment and the targets in the Paris Agreement factor into corporate decision-making? How will banks and other financial institutions change how they weigh up sustainable investment choices? And what impact could all this have on the broader economy? To join me to discuss all this and more is Aled Jones, Head of Sustainable Investment in Europe for the FTSE Russell, Benedict McAleenan, Senior Advisor on Environment and Energy for Policy Exchange, and Kate Norgrove, Executive Director of Advocacy and Campaigns for WWF, and this panel is kindly sponsored by WWF. If you are interested in putting questions to our panel, you can submit those questions through the text box on Spectator TV, or you can email events@spectator.co.uk. So we'll get a few opening remarks from each of our panelists, I'll ask a few questions, and then we'll go straight to your questions. Benedict, let's start with you.
Thank you very much, Kate, and thank you very much to the Spectator for hosting us today, and also to WWF for sponsoring this very important event and this very important summit. I'm delighted to come and talk to you about the financial sector and its role in achieving global net zero. And really, it has an absolutely key role. In fact, we cannot get to where we want to go without it. And that's always been the case with the financial sector and human society. Wherever there's been massive progress in human society over the last few centuries, the financial sector has been incredibly important. When Christopher Columbus wanted to go across oceans, the only people who could finance that were royalty. And yet nowadays, or in fact just 2 centuries after Columbus, there was this thriving financial sector which could fund trips around the world all over the place. So, but they did that by pooling resources, by pooling risk, and that's really this hugely important role that the financial sector has to play. It enables society to do what it wants to do. And nowadays, society wants to get to net zero. We want to improve our impact on the planet and actually turn that into a positive impact rather than the negative one that it is today. So the financial sector is an enabler. And that's actually the first of 3 areas that I think that the City of London can play an important role. So those 3 areas are enablers, as accountants, and as regulators. So firstly, enablers. There is a huge number of products that the City of London can sell to the world that can enable it to get to net zero. So that might be financing new technologies through investment or underwriting it. It might be issuing green debt, which supports new infrastructure projects. It might be in researching opportunities and using its expertise in getting the most efficient allocation of capital, so that cuts the cost of the net zero transition. Banks like NatWest and TSB are issuing mortgages that are linked to homeowners' investment in energy efficiency, for example. So there's all these opportunities that you can sell to the world as an enabler through the products that you sell. Secondly, accountants. It's been said in the past that accountants will save the world, and I absolutely believe that, because there's a real problem in ESG data that it's pretty fuzzy and there's lots of overlapping and double accounting, and we need to solve that through much more efficient accountancy methods. And the City of London sits as a global financial hub, and it has this huge opportunity to set the standards. The financial world is sort of coalescing around certain things, certain standards and frameworks, but it's taking a little bit of a time to get there, and we need that to improve. And I'm sure Aled will speak about that in a moment. The third area, and that sort of neatly leads us on to the third area, regulators. In terms of setting standards, the UK has this massive role. As I say, it's a financial hub. It has this huge role in influencing how business is done. And I think it was the head of UBS said, we can't just add a few more galaxies to this universe. We need a whole new universe. We need to reset the standards for how everything works. So it was fantastic to see TCFD being adopted by the G7 recently. That's a framework for disclosing risks in the financial sector related to climate change. We called for that at Policy Exchange earlier this year with a report that I co-authored. Brilliant to see the G7 adopting that. There's a couple of problems with that though, or rather limits to it. And those are that it's focused on risks and material impacts in the financial sector. We need to see transition plans that companies adopt to show how they're moving to net zero. We need to see things like a task force for nature-related financial disclosures, and we need to see things like capital charges, which are rules for banks' stability. They need to start recognizing the inherent risks in fossil fuel investments. There's a huge range of other things that regulators can do, but the UK has this massive role, and it's already shown with the G7 that it can take a leadership position. So I want to see more of that sort of thing. I think a bigger thing that the City of London has to offer to the world is its heritage of principles-based regulation, which is really effective in terms of allowing a culture of innovation within a sort of within a broader-based set of regulations that encourage green innovation. So the City of London has this massive and central role to play as an enabler, as accountants and as regulators, and I think that it's an essential and indispensable role that I'm looking forward to seeing develop over the coming years.
Thank you so much, Benedict. Alid.
Thanks, Kate. And I echo Benedict's comments. Thanks, Spectator and WWF for making this happen, and to everyone who's signed in first thing on a Monday morning to talk about climate change amongst other jolly subjects. I'll perhaps, there's three broad comments I just want to make to sort of set the scene, and then I'll pass over to Kate. So from my perspective, so I work within the index business of FTSE Russell, which is part of the London Stock Exchange Group. So I spend most of my time speaking to large investors and asset owners in particular, like pension schemes, large pools of money that are looking to put money against kind of index-based products or use benchmarks to understand the markets they're tracking essentially across their investment strategy. So three things that I kind of see emerging from discussions that I have across these European investor base. One, climate, as you might not be surprised that given what we're talking about here, is never been higher on the investors' agenda. I mean, and it's happened very, very quickly actually to get to the point where we are today, talking about net zero compared to 3-4 years ago when everyone was just talking about carbon emissions and low carbon approaches. It's really skyrocketed up the agenda. I mean, there's assets flowing into funds. There's all sorts of commitments coming out. I think Kate mentioned at the beginning in her remarks about net zero commitments. There's support for quite progressive agendas through groups like the IGCC, the Institutional Investors Group on Climate Change, the Transition Pathway Initiative, CO100+, all things that I can happily get into later. It's really, certainly in Europe at least, it's really top of the investors' agenda, and I don't see that changing. Secondly, the debate, as I alluded to earlier, has become much more sophisticated in a very short space of time compared to, say, just 3-5 years ago. So, as I mentioned, 3-5 years ago, people were just talking about carbon emissions. How can we lower the carbon intensity of our portfolios? Now it's about how do I get to net zero, which is a completely different thing. I mean, it still encompasses those same issues, and carbon is definitely a big part of that. But it's a level of complexity that didn't exist not that long ago. That is tricky in many ways for the average investor, say like a pension scheme trustee, because there's no right way of doing this. And Benedict alluded to the fact that within the world of ESG, there's very few, if any, standards, which can be a challenge. So there's no right way of getting to net zero. There's no right way of assessing your portfolio for ESG risks. There's no right way of assessing a company based on ESG metrics. And again, happy to get into that. So it's great to see the debate becoming much more sophisticated. I do think from an implementation perspective for the average investor, it can be quite tricky. And the last point I'll make for now is I think certainly from the perspective I come at this, so index-based investment for the most part, it's as much as, if not more, about risk than it is about returns. In the sense that I see most investors that I work with looking to essentially take a very large broad market portfolio that invests in thousands of stocks through which they're trying to earn like the market return or market beta. they're trying to sort of shift these portfolios progressively towards, say, lower carbon companies, or maybe slightly greener companies, or quote unquote more responsible companies, which is about managing risk at the same time as generating or receiving at least the same kind of returns or risk-adjusted returns you might get in a standard, what we call market cap portfolio. Now, there's lots of interesting opportunities, especially around the green part of the economy, but from a broad market investor perspective, most of the discussions I see, this is really about managing risk, and when it comes to climate, there's plenty of risk to be managed. So I'll leave it there.
Thank you so much, and over to you, Kate.
Thanks, Kate. And I want to thank the Spectator and our guests for taking the time today to talk about what is possibly the biggest opportunity for the UK. Because although obviously it's about risk, it's also about returns. Mark Carney and others have talked about just how much of an opportunity there is in this sector. We need to mobilise our world-class finance sector and transition that investment flow to accelerate the whole economy to a 1.5 degree pathway. And doing that will support the industries of the future and make the UK the world centre for green finance. So you might be asking yourself, why are WWF, an organisation that's known mainly for conserving megafauna, deciding to partner with some of the big beasts in finance? And that's quite simply because the challenges that we face are now so large that saving just one species misses the point. We must fix the systemic issues that are driving climate change and the loss of biodiversity, not only for those species' sake, but also for the human species' sake, because this is now an issue that threatens all of us. Our planet is no longer in the safe operating space upon which our civilizations have been made. As an organisation, we strongly believe that our work needs to be grounded in good science, and you'd expect that, whether that's advising on camera trapping for lions in the Serengeti or supporting HSBC's science-based net zero targets. And the science tells us that we can't keep using our planet's resources or emitting carbon dioxide at the current rate. And you'll have seen this already. Storms, wildfires, the rain this weekend, floods, extreme temperatures, and other climate-related natural disasters are more frequent and more violent, and they're more likely to be caused by climate. They're destroying our homes, upending lives, and costing billions of pounds each year. And the global economy cannot carry on as if it's business as usual. In fact, this pandemic, the COVID crisis, is linked to biodiversity loss because humans and animals are getting much, much closer together because of deforestation. So it's a massive risk to the whole economy. The UK's finance sector punches above its weight in many ways, but that also includes in its carbon emissions. So our recent report, WWF and Greenpeace, The Big Smoke, showed that financed emissions from a subset of just 25 UK banks and asset managers were equivalent to 1.8 times the net emissions of the UK. So at a very, very conservative estimate, that says that the UK's finance sector is supporting emissions that, were it were a country, would see it ranked 9th in the world, so more than Canada and only slightly less than Germany, which is pretty extraordinary, really. So the financed emissions of the City of London is going in the opposite direction, still financing fossil fuels to the extent that it is, to the UK itself, which is starting to pull out of all of those. So reversing this trend is a massive challenge, but it's also a big opportunity. It's a really exciting time, as we were just saying just before this all started. There are so many financial sector organisations now talking about net zero. The private sector has always been at the forefront of innovation to solve problems. We now have the chance to ensure that the finance sector leads the world to a cleaner, more sustainable and stable future. Let's seize that opportunity, and let's do it in the year that the eyes of the world are on the UK. Because given the international nature of the finance sector, changes in the UK would send shockwaves globally. So credit where credit is due. The fact that we're here today shows that the dial has started to be shifted and greening finance is firmly on the agenda. The UK government have fired the starting gun and rightly recognised that this isn't just about corporate responsibility and a sideline in CSR. This is a UK leadership opportunity. Mandatory climate disclosure, so the TCFD thing that Benedict just talked about, is a fundamental first step. This does allow us to see where the risk is and what needs to change, but it's only really the calories on the pack. It just tells us what we're emitting now. It doesn't tell us what the plan is to get to it. And that makes it a very slow nudge game. And time is not a luxury that we have. So we must realign our financial system so that it drives the outcomes consistent with the Paris Agreement and the achievement of 1.5 degrees, so that investment flows faster towards a low carbon economy. We must do this in the timeframes outlined by the science, and for that we really don't have long. And there's a massive role for the UK government as presidents of COP26 to lead the global agenda on this, levelling up laggards so that our world-class financial system is supporting our climate ambitions, not undermining them. So that's why we want the UK to commit to being the first in the world to align our finance system with the Paris goals and net zero targets. And I'm really looking forward to this discussion on how we can move forward on the journey to achieving this.
Well, thank you so much, Kate. We already have questions coming in, which is fantastic. I'm going to abuse my position as chair and ask a few myself before we get to them. And just a reminder to all of our watchers at home, anybody can submit a question. Use the text box on Spectator TV, or you can email events@spectator.co.uk. I just want to pick up on some of the, really big statements that have been made in these opening remarks. I mean, Kate, you say that if we look at the emissions that the city is financing, it's equivalent to the 9th largest or 10th largest polluting country in the world. I mean, where to begin on that? How does the city go about navigating the trade-offs of where it feels it has to continue to invest where the money is, and how it makes this huge switch to supporting more green and clean industries and sectors and initiatives?
Yeah, I mean, it's unbelievable. It's one of those things where we have to start to have the policy to enable this shift to happen quicker. And as Benedict was saying, we need to realign the finance sector with our net zero goals and with the goals of the Paris Agreement. So it's a really good first step to have had TCFD, which is the format, I guess, that allows you or enables you, makes it mandatory to disclose your climate risks. But that's nowhere near enough. It sort of measures the temperature we're at now rather than turning down the heat. So what we need is the government to say, look, by the end of 2022, so what we want is by COP26, the government to have said, by the end of 22, we expect finance sector to publish their plans to reach 1.5 degrees to align with the Paris Agreement. And that will give financial sector sort of 18 months-ish to do the work to publish that plan, because otherwise we're in the situation where they've said, these terrible things are going to happen, but they've not, and this is a massive risk to our business, but they don't have to do anything about it. And some of the world's leading organisations, like Aviva, for example, have already published their plans. It's totally possible to do, and that's what we expect others to do as well.
Benedict, it may be possible to do, but it's still a huge challenge. Are you hopeful that in the next year and a half, such a plan will be delivered?
I'm an eternal optimist, Kate. I think you have to be in this game, but look, there's definitely going to be challenges along the way, but we are seeing a big change at the moment, and this is a crucial year, as Kate said. We've got COP26 at the end of the year, but we've also got and especially the UK has a key role in these things. We've got a new administration in the White House which has made climate change its one of its top 3 goals. We've got a number of diplomatic summits which are crucial. So COP26 is obviously incredibly important. We've got the G20, which traditionally has a sort of financial focus, and that's being hosted by Italy, which is also closely involved. We're partnering with Italy on COP26, so that has a sort of a focus on this stuff as well. We've just had the G7. Didn't have a huge amount of progress, if we're honest, about climate change, but it certainly set a sort of tone and an agenda in the right direction. We've also got things that are slightly less high profile, but things like, that we've got the Commonwealth Heads of Government meeting later this year. And when I was talking about principles-based regulation, that's a fantastic place in which to advance some of these agendas. Can we do it in the time available? I think, yes, we can, but we do need to get a move on. And I would absolutely echo Kate's point that each individual company has to come up with a transition plan. When we talk about TCFD, which is big, headline banner thing, that's about risk. We need to talk about actual actions that are moving companies in the right direction, in line with the Paris Agreement's 1.5 target. And that's down to companies themselves, but it's also up to investors, and those investors are taking an active stance on this. I would encourage your viewers to look up the Say on Climate campaign. I think that's very important. There's obviously a lot more to be done by governments, and we can come on to that later, and love to talk about that in a moment.
And speaking of those investors, Alid, where do they begin when it comes to making this monumental shift? Because they have so many competing priorities. They're looking at profits. They're looking at what they think is going to be successful in the short term, but then of course making this huge shift over the next few decades. I mean, is there a practical step-by-step handbook to this, or are we in completely new, uncharted territory?
I wish there was a handbook. We're certainly not in uncharted territory. I mean, this is an area that I, at least along with many other people, have worked in for many years. But it's good to see the spotlight really shining on these issues finally in the last, say, 2-3 years in particular. I think it is challenging because, as I say, there's a lot to get your head around as an investor, because these aren't kind of typical. The climate transition is not kind of typical investment strategy kind of thing that you capture in these discussions. The information can be patchy, but there's a lot of positive signs. So one example is the Transition Pathway Initiative, the TPI. They since 2017 have been trying to support investor efforts here by assessing companies in a fairly intuitive and very transparent way to give investors the information they need to start making decisions, whether it's about companies to engage within their portfolios, companies to maybe invest more or less in based on their performance on different characteristics, or maybe even completely avoid. So what, in particular, they look at, for example, to what extent have companies committed to reduce their operational emissions in line with what we know is needed to hit these Paris goals. They look at, say, the 400, 500 biggest and most carbon intensive businesses globally, and then they assess them in different, and put them into different buckets. So based on their latest transition sort of summary report, only about 15% of those 400 companies they were looking at last year, say, have got any kind of plans to hit these 1.5 degree warming targets. So that's quite a small number when you think about it, even though these are very large companies. And actually, if you look at, say, a listed equity universe, that group of companies, while small, does account for upwards of 50% of the carbon intensity of that particular universe. So, but this information is a starting point. They're essentially trying to say that we're all investors. We want this to work. We don't want to have to ideally divest from these companies. Let's work with them. Let's help them understand the importance of this transition and what investors need to know. Very much linked to the TCFD, which is this sort of disclosure framework that Kate mentioned. But I agree, it is that's just very much the starting point. We need this information so we can make informed decisions about where to allocate our capital over the long term. So the TPI is one part of that process. They're linked to other initiatives like the CO100 Plus, which is a very, very engagement focused program. And that's, again, looking at these large carbon intensive companies. And again, the outcome really is kind of at this stage around disclosure and commitments, like pushing companies to make clear and public commitments to reduce their emissions in particular, out to 2030, 2050, so we can, at least as investors, start to understand which companies might be winners and losers. Because the bottom line is that we want these energy, automotive, airline, utility companies to make this transition, but the bottom line is they won't all make it because it might not be possible, or maybe they're dragging their feet. But this is, I say, it's tricky because there's a huge amount of urgency here, but we are in quite early days in terms of the broad group of investors actually getting their head around what they can do and how and why. But things are, the encouraging sign is things are, like I said earlier, moving very, very quickly. I mean, it's astonishing how much attention is now being placed on this issue in kind of investment circles. So that for me is the optimistic point here.
Well, clarity is key. Benedict, you mentioned ESGs and that oftentimes it just actually, the data around it wasn't very clear. I mean, investing in ESG does seem to be all the rage these days, but do we have the data to know whether or not it's actually making a difference yet?
I think it's a good question as to what exactly is making the difference. I think that there is ultimately, I'm not sure that the market necessarily is in the driving seat at the moment. It is responding to major trends in regulatory change and policy change around the world. But we are seeing certain asset classes becoming increasingly uneconomic. There's a lot of doubt around, investment in coal, for example, even though we hear lots of horror stories about, further investment in coal. But a lot of that investment is backed up by effectively sovereign wealth funds, especially in the Chinese Belt and Road Initiative. So we're seeing asset classes that are shifting out. And that's out of the sort of acceptable market investment portfolio, because that's a response to regulation and also a response to public perceptions. We talk a lot about transition risks, including the way that consumers view products and services. If you see a company that is investing in coal, that makes you less likely to buy its products because you don't want to engage with that. So in some ways, we're seeing asset classes moving out of the mainstream market, and you're certainly seeing an awful lot moving in. So we're seeing a massive uptick in the value of green technologies, and I think that is a combination of regulations moving in the right direction, lots of noise around that at the sort of global level politically. And then secondly, market investors recognizing there's something to be had here. So we saw the creation of around 500 ESG funds last year. I think that is part of a pretty much a mega trend, and that is going to have a difference. But it needs an awful lot more structure and an awful lot more data to support it.
Kate, what do you think? Do we have enough data and evidence at our fingertips to assess the changes being made in the city?
We certainly need a lot more. Like Aled and Benedict have referred to, this is not simple. It's complex, and the transition out of dirty industries to cleaner ones when it comes to climate is difficult. But when you add in nature as well, it becomes even more difficult. So how do you measure moving out of deforestation in your supply chains, for example? And that's where something like TNFD, which Benedict was referring to in their report as well, is so important. And we've seen, in terms of ESG, we've seen a significant rise, as others have said, in the uptake and importance placed on ESG investing. This is, of course, welcome, but it doesn't necessarily result in the big changes we need in the real world. And so we need to go beyond the sort of basics of ESG data metrics, climate risk disclosure, and more towards the portfolio alignment with 1.5 degrees and net zero. I wanted to just mention that I think alongside this, that having the government policies that help support the transition or make clear to the finance sector where the transition needs to happen are so important. So when Benedict was talking about asset classes in relation to fossil fuels and green technology, the other area we need to look at, although it's less well known, is agriculture. And so what are the UK government policies on agriculture going to be? And can we use those in the finance sector to help drive the finance sector to the right type of investment in agriculture for the future? And one last point is that politically, this is such an amazing opportunity for the UK government to put their weight behind 1.5 degrees and a Paris-aligned financial sector in the UK. It's just a no-brainer, I think. We could be the first financial sector to make that announcement, to align the City of London. And it's just a big opportunity for the UK and for the City of London that we shouldn't miss the idea of taking up. It's a great contribution to global Britain, as Boris Johnson would say.
We've had a question through about the possibility of a green bubble as people rush for ESG. There's phenomenal interest in Tesla, but some are already critical about its valuation and in the valuation of electric vehicles more generally. Aled, with your investor cap on, are you at all worried about a green bubble that may be set to burst?
Personally, no, then it's not necessarily my specific area of expertise, but I mean, Tesla's a good example because the phenomenal, what is achieved is phenomenal. The attention it achieves is incredible. It has a very charismatic, slightly bonkers chief executive who's very good at keeping staying in the spotlight. I guess there is, to make a couple of points, there's a lot more capital shifting into whether it's ESG funds or across the spectrum of passive and active, deep green thematic, very broad, sort of ESG integrated. In the tens, if not hundreds of billions of dollars flowing into these kind of approaches. But a lot of the time, it's not just green funds. There's a huge range of different funds and products out there. And as I mentioned earlier, what I do day to day is mostly about taking what you think of as a very standard portfolio and essentially sort of nudging it, to use Kate's comment earlier, towards companies that are perhaps a bit better than others. So it's actually, in terms of the capital shift currently, it's not significant enough in my mind to create huge bubbles in companies that seem as being more responsible or having better ESG practices or being low carbon. Now, I think the Tesla point is particularly interesting for me as a bit of a kind of ESG nerd, in that when you look at large global equity universes, you look at the top 10 holdings, the biggest 10 companies in these universes. Companies like Exxon have forever been in that top 10. Is a very, very large global oil and gas company. In the last few months, not least because of what's been happening in the wider economy, Exxon's disappeared from the top 10 and Tesla's now in it. And that's a big shift. Now, whether that's a bubble or whether that's the first signs of an actual transition away from, say, fossil fuel sectors towards, say, greener sectors is yet to be seen. I think it's too early to say, but it's a very interesting question. But also Tesla's fascinating because if you look at just its products, it's extremely green in the sense that it's trying to encourage us to have electric vehicles, solar panels, batteries, etc. But if you look at it from a broad ESG perspective, which is more about understanding how operations, the operational side of things, like disclosure levels, corporate governance, how it treats its workforce, etc., it tends to do extremely poorly. So, and that's a great, and for me, fascinating, interesting contradiction sometimes within ESG is like you're having to balance these decisions sometimes between, do I go full green and just kind of focus on that, or do I factor in some of these broader things which are also extremely important around labor relations, etc., diversity, etc. Now, and then so Tesla sits right at the middle of that kind of discussion. So I think, but there's many other examples you could look at. ESG, like the world around us, is very much about, there's no black and white. It's very much about grey areas. And I think in terms of today, Tesla actually is a great company because of what it's producing, and it's also made some very strong commitments around the climate transition. So the TPI analysis I mentioned earlier has Tesla very much aligned with 2 degree or below 2 degree in terms of its operational carbon emissions. So from that sense, I think it's to be applauded, but it could definitely do a lot better in terms of broader disclosure and some of its operational practices.
Benedict, we've had a question through from Alan, who asked whether or not renewables can comprehensively replace fossil fuels. I suppose it ties into the green bubble point. I mean, either this is going to become a new way of life in which we're not talking about bubbles, we're talking about, the way that we use and consume energy, or it's not. Where do you fall down on this? Do you think they can comprehensively make the shift?
I think it's a very important point, and in some ways it relates to the previous question. So the previous question, I would say, there's two different types of bubble. There's the sort of tulip mania that was seen in the Netherlands a few hundred years ago, which was about fashion. It was a sort of flash in the pan, and so when it burst, that was, that didn't change anything structurally in the global economy. Whereas what we're talking about here is the real fundamentals. Energy sits at the absolute base of the global economy, and so I don't think that in the long term it's a bubble, and there might be a bit of frothiness around certain companies in the short term. But if you're a long-term investor looking at green investments, then it's a fantastic thing to be looking at. And to answer the question about can renewables replace fossil fuels in the global energy system, yes, absolutely they can. There are questions around things like intermittent sources of energy that are dependent on the weather, so wind and solar and that sort of thing. But those are the sort of questions of maybe 10 years ago, and those countries that are ahead on decarbonising their power sector, such as the UK, are showing that you can absolutely manage through a combination of things like demand side response, batteries, and dispatchable energy sources like hydro or bioenergy or things like that. You can balance out those sort of peaks and troughs in the energy system that you are going to get, but it can absolutely be done, and there's no question in my mind that renewables can completely replace fossil fuels.
And Kate, we've also had a question through about corporate governance. One of our watchers has said that they've heard reports of executives having their bonuses tied to meeting sustainability targets. Should we expect to see more of that? I mean, at the end of the day, leadership does come from the top, and it seems like a fairly important point to be talking about when we talk about the City of London, what the chief execs are actually up to.
That's bang on, and I think the most progressive companies have got climate and nature as part of the responsibilities of various board directors. So look at Tesco's for the moment, for example. They like all retailers, they work on the basis of quite short-term in terms of thinking about their risks. Their risks are about, is there going to be a disruption in their supply chain next week, let alone thinking about the long-term risks, 3-10 years out from climate and the destruction of nature. But they've now got a board member at the most senior level responsible for climate and nature risks, which means they are having now and proactively dealing with the risks that are for their business over the next sort of 10, 15, 20 years. There's a question just going back to the bubble question, if I may, around whether the carbon bubble is actually the one to be more worried about, because given the majority of the economy is now dependent on fossil fuel based energy production, and we know carbon use is limited by science, I'd be much more worried about that than I would be about anything else. And just on the renewables question as well, like I said, I think there's big focus on the energy transition, quite rightly, but in some ways that transition is happening. It's on its way. Whereas 25%, quarter of the world's carbon emissions are produced by agriculture and the way we use our land. That's the next big area to look at in terms of the transition, both from an opportunity and a risk perspective. And so both governments should be regulating on this, as we are in a way, as we've sort of got out of the common agricultural policy. But finance sectors should also be looking at this as well.
And it's not just boards holding their CEOs to account in the way that they're leading their companies, is it, Aled? Shareholders have a lot of sway and control over holding companies to account as well for their climate impact. Do you think we are really seeing the difference that a shareholder's decision as to whether or not they want to invest in a company is making?
I mean, I think the point around shareholder engagement is a really important one. I think there's always been a lot of engagement with companies over the last decade and more by leading investors, whether it's investors like Aviva that Kate mentioned earlier, or groups of asset owners through things like the IGCC or the UNPRI that I mentioned. I think it's starting to really become, especially around climate, it's starting to have a lot of success. I think the approaches and the asks of companies have become more sophisticated, more perhaps you could say investor aligned, and I guess capturing the current level of debate, I guess, around climate are just being more successful. I mean, you'd have seen in the last month, Exxon, engagement with Exxon, which has historically been very difficult, having huge successes in terms of getting, perhaps you could say, more open-minded board members onto that company board. And there's other examples in recent years through initiatives like Aiming for A under the CDP. So there's some, and the CO100 plus I've already mentioned is definitely being successful in terms of pushing for much better information and commitments around Paris. So I think there's a long way still to go with that, especially within in the passive investment context as well. People have historically thought, well, if you invest passively, you can't really effectively engage. But I would disagree with that. I think as as a passive investor, especially as an asset manager, say, where you're investing in essentially the entire economy, I think it's incumbent upon you to engage with companies, even if you can't necessarily sell them because you have to hold the market. But you're essentially a perpetual owner of these businesses, and you or your clients' assets, at least, if they're facing risks under climate change, then it's absolutely required that you engage with these companies pretty vigorously. I mean, we're starting to see that a lot more. One last, I was going to make one quick additional reference to the green economy point we were talking about earlier. Is so there's it's quite often when people think about the green economy, they just think renewable energy, right? It's so much more than that. I mean, if you look at so we have firstly track the green economy through a green revenue data set that we have, and we put out reports every couple of years, which we try to, on the state of things. And if you break down the green economy as we look at it, at least half of the global green economy is actually taken up by things like energy efficiency, increasingly technology companies, transportation, and obviously renewable energy, both the companies that make equipment to support renewable energy, but also utility companies that generate green energy is a huge part of what we're talking about. But it's just so much more than that, and the opportunities across the global kind of landscape are getting bigger and bigger. If you don't just look at, say, what you might call a pure play green company, it's maybe that only make solar panels or a particular widget that goes into a green product, and you look at companies that are active in many different green sectors, like I said, like waste or energy efficiency, et cetera, you've got globally an opportunity that's in the trillions. I think it's around $4 trillion or something we've estimated, and it's actually now at least the same size, if not bigger, than the global oil and gas sector. So and we're seeing those sectors, green is growing and oil and gas is shrinking, at least in terms of market value. So again, these could be promising signs of a transition that is underway and picking up steam.
Kate, what role do regulators have to play in this? I'm thinking, for example, of the Bank of England saying it might penalize banks facilitating heavy polluters.
Yeah, certainly. And there are already moves. I mean, the Bank of England has just taken on, as you said, this new requirement that they look at transition plans and make judgments according to those. I think without regulation, we're not going to do this. It's not happening fast enough at the moment. And the one thing, as I've said, that we'd like to see before COP26 is the government to commit to asking the financial sector to publish their plans to meet 1.5 degrees in the way that they invest. So we're not going to do it without regulation. It's not going to happen fast enough. And I just wanted to come back, if I can, to the public action point, or the sort of stakeholder action point. There's 2.6 trillion in UK's pensions, and that money is essentially owned by the public and is expected to build our investments for the future. But that's a really good way of individuals taking action, because from fossil fuels to tobacco, exploitation to extraction, pension, our money is invested in things that may not align with our values. So Richard Curtis has got this campaign called Make My Money Matter, which is about getting people to shift their money to pensions with values that they agree with, and we would certainly support that. There's a really good and important role for financial for the financial sector to also be working with regulators to make sure that regulation works for them, and that that the regulators have some role in accountability and enforcement of the policies that are mandated for them.
Benedict, regulations are necessary in some sectors and in plenty of areas in order to keep everybody, at a fundamental level of safety. But they do, of course, have unintended consequences a lot of the time, and we've seen that especially in the green sector. Seeing as there's so much demand for ESG-friendly investments, is the solution more regulation, stricter regulation, or perhaps that we just need stronger signposting?
I think there's a difference between the types of regulation and the different approaches that we're seeing around the world. So in the UK, we have the common law system, which has lent itself over the years to principles-based regulation. The EU, on the other hand, is the standard bearer for a more sort of civil law approach, which it inherits really from France, and that's led to rules-based regulation. And in my view, rules-based regulation leads to effectively box-ticking culture that can't really keep up with changes in technology and the real world out there. Whereas principles-based is much more sort of broad, and it says, here are the outcomes that we're looking for, here are the types of behaviors that we're looking for. And that allows you, firstly, a slightly lower regulatory burden on these companies. Also allows more sort of opportunity to innovate and to come up with your own solutions rather than just ticking the box of what the regulators are looking for. And it also encompasses all sort of situations rather than just the ones that the regulators were thinking about in advance, which means that you can sort of try and prevent gaming of the system and those who are sort of trying regulatory arbitrage and that sort of thing. So there are definitely ways you can design this regulation in a way that is hopefully lighter touch. But ultimately, the best ways of doing this are things like market-based solutions, things like setting a global carbon price, or at least one that you can implement in local scenarios that reflects a sort of internationally respected standard. We need these sort of international agreements so that we're all on the same page on this.
Ali, do you think that a global carbon price would actually give investors some sense of relief, even if it meant that in some areas prices were going up, taxes were going up? At least there would be certainty as to how we're going to handle this question of combating climate change.
I mean, certainly, exactly what the answer is, I don't know, to be honest. But we clearly need a means of investors and companies actually being able to price some of this risk and reflect, have it reflected in market prices, whether it's a carbon price or some sort of taxation. I'll perhaps leave that to the policy experts. But there is, I guess, the reason we're here today, right, is because the market so far has failed to kind of effectively price this risk we're talking about, which is climate. So and the measures, the activities underway in these kind of discussions are definitely helping. And there's many measures thankfully happening, including in the UK, requiring asset owners, for example, to now report against the TCFD, etc. Now, it could be that stronger measures are required. Obviously, agreeing a global carbon price is, I imagine, incredibly complex. And even the balance between, as Benedict was saying, kind of rules-based and principle-based regulations is a tricky one. And I agree that rules-based can be overly prescriptive, and we're perhaps seeing that in some areas currently from some of the rules coming out of the EU. But equally, principles-based, one could argue, might be too slow to see kind of real concrete change, depending on how that's backed up. So I think we need a kind of a package of measures here, and actually we need investors in particular really holding companies to account. And you could argue also that the end client really should be holding their investment intermediaries to account as well here. There's a long chain of stakeholders that need to be connected up to make all this stuff work. But to your specific point, some measure of pricing this risk more effectively and systematically would be extremely helpful.
And Kate, this brings us to COP26. These are the difficult conversations that world leaders are going to have to be having, and they're going to have to find some areas of cooperation if they are to tackle this at the global level. Is there a risk, though, that we come out of COP26 with more pledges, more lofty promises, but we haven't actually gotten into the gritty politics and policy like we've been discussing today?
Yeah, I mean, there's always that risk. And COP26, it's not going to be like Paris in sort of a big moment where everyone agrees on an amount, because this is about ratcheting up individual countries' commitments. And I think there's a risk of expectations that we say, okay, well, COP26 is going to be the big moment where everything happens. And it may not be like that, but I'm pretty sure that there's going to be some decent progress. And I think in the UK, at least, that will be driven by domestic action and policy certainty in domestic action. So one of the things we're looking for in the autumn is the publication of the government's long-term strategy to reach net zero. And we hope that that's going to cover a bunch of sectors. And talking about regulation, that they will announce a net zero test on all of government spending, so that there's some policy certainty that the core spending is spent in consistent ways with the net zero target. So if we can see that, then I think we'll be in a much better position to ask for the financial sector to do the same thing, and ask for other governments to do the same thing as well. And I think there's lots of hope in the Biden administration, in targets being announced by China in recent months to reach net zero at least by 2060, and to start phasing out of coal by 2030. So it's obviously not fast enough, but it is moving in the right direction. But overall for us, success will look like 1.5 degrees being still on the table and still feasible by the end of COP26. And so that's what we'll be looking for.
Benedict, we've had a question through asking whether or not the city really does want to achieve net zero and get to that target, or whether or not the commentariat wants the city to want to achieve net zero. And it's fair pushback, isn't it? You could look to plenty of business in the City of London and say, well, your practices or what you're still investing in really doesn't look like net zero is at the heart of your agenda. In your conversations with business, how seriously do you think they're taking this target?
I think you're obviously going to find a huge range of people who are just out to make money. And let's be honest, that's what the city has been built around. But also, you get a huge number of people who are genuinely committed. They want to use the position that they have in the world to influence this agenda and support it. So I think that there is a range. We do hear from leading investors, large investor groups, the types that Aled has been speaking about, that that this is absolutely core to their agenda, and they're going to press the companies that they're invested in to ensure this. I think that's a sort of the kind of the moral position, but there's also the hard-nosed material point that climate change is going to cause damage to portfolios, to loan books, to underwritten assets around the world, and that goes to the bottom line. So when we talk about implementing TCFD, all we're talking about is identifying the financial risks that underlie assets, and I'm talking about assets all around the world in almost every single asset class. And those assets are becoming stranded either totally or partially by climate change, either by the physical reality of climate change or by the policies that are being implemented. So that goes to the bottom line. So if you're an investor and you're not thinking about how this massive global megatrend, this phenomenon that has never happened before in human society, if you're not thinking about how that's impacting your investments, then you're really in the wrong job. So I think there is a huge awareness of that, and it's a growing awareness. And it's not just PR, it's not just froth, it's a recognition that this goes to the business case of the City of London. So I'm optimistic that it's being accepted in increasing seriousness.
Aled, do you think that business case has helped to sway hearts and minds, the idea that climate change is going to have a big impact on some of these assets?
I think so. I mean, I guess you can look at this in different ways. I mean, one, the market essentially takes a consensus view on how it thinks companies will do in the future, right? And that's reflected in current market prices. Now, if enough people believe in something, then that will get reflected in what the market thinks of these companies. So if enough people are concerned about climate risk and excited about climate-related opportunities going forwards, then those views will ultimately get reflected in how investors in aggregate evaluate companies, right? So that's kind of, and maybe like the point about Tesla versus Exxon earlier, maybe that's what we're starting to see. I don't know. I mean, it could be too early, but I think again, I share the hope of others on the panel. I think one reason why the engagement by investors on climate is, I think, starting to be incredibly successful, is that you're actually talking about quite a small number of companies. If you look at there's thousands of companies in the global equity universe. It could be up to, well, depending on what universe. So a global developed market universe, you're looking at, say, 2,000 companies easily. Within that, at most 10% of those companies are kind of like high carbon companies. So it's a relatively small number of companies, and that's where investors concerned about this agenda, I think, is starting to be very successful, because they've realised it's a small number of companies. This risk is very, very concentrated in, say, 200-ish plus companies, and that's a number you can work with, right, globally at least. And so there's that. That's why I think pushing for extra commitments among that relatively small group of companies is starting to be successful, and will continue to be so. And that, as I say, will links back to what I was saying about market consensus on what the prospects for these companies are. And I think companies do care about how they look compared to their peers. And so perhaps the recent events in the Exxon shareholder meeting again is a further sign of that. So I think all of these things do matter. I think companies care. Obviously, large oil and gas companies are still essentially taking fossil fuels out of the ground, which in this context is problematic, but they're going to keep doing that for the foreseeable future. But if they can at least commit to these transition targets, then that sets us on the right path.
We have about 90 seconds left, so Kate, I'm going to give you the last word. What about your experience speaking to these businesses in the city? Do you think that we're pushing our wishful thinking onto them, or are you quite hopeful that this is actually a goal that they have in mind?
Well, I mean, amazingly, we've seen commitments in line with net zero by 2050 from HSBC, Barclays, Aviva, Morgan Stanley, Santander, lots of companies, but not enough, as I said. And I think the important thing to think about is that there's the economic argument, as we've said, this is an area of growth. And then there's simply being a good ancestor, being a good person, thinking about the future. And then in all of this, there's a role for government now, as they're responsible for our society, for the economies, and for the future we leave the next generation. So there's no greater and more important thing at the moment for the government to do, which is to align our UK's financial sector with 1.5 degrees.
Well, huge thanks to our panel for giving us so much to go away and think about. Don't leave us just yet, however. You can watch our next event on green business practices, how businesses can achieve net zero in 15 minutes time. But for now, Kate, Alid, and Benedict, thank you so much for joining me, and a big thanks again to WWF for sponsoring this panel.